Good morning, everyone. My name is Joe Cannon, and I'm a director in the Corporate International Tax team at BDO in London. I work with the international manufacturing team, working with UK manufacturing groups and international groups, advising on all aspects of their tax affairs. Over the last 2 years or so, there have been a number of key events that will ultimately lead to a fundamental change in the international tax landscape. So this includes Brexit, the OECD's 15-point action plan on base erosion and profit shifting, and more recently, the US elections. So the focus of my talk this morning is to share 7 tips for UK manufacturers on how they can navigate these changes to the international tax landscape and mitigate any risk. So let's kick off with Brexit. Since the EU referendum in June 2016, there has been a lot of speculation as to how UK manufacturers will be affected by the UK's departure from the EU. Where we are now, we still have a lot of uncertainty as to what the UK will need to do in terms of negotiation. However, I think following Theresa May's announcement in January of this year, we know that actually we're going down a hard Brexit route. And this gives a little bit of direction in terms of how manufacturers may be able to start planning to make that transition a bit easier when we do eventually leave the EU. So my first tip really is focused around Britain's exit, or the UK's exit from the EU single market. There will inevitably be additional costs around VAT, customs duties, and possibly employment costs. And businesses should start to think now about how they can manage the additional administration and VAT registrations, as well as the additional cost in terms of managing VAT cash flows. So we recommend that businesses start to model and plan ahead now in order to make that smooth transition. In addition, the UK companies will no longer be able to rely on the various EU tax directives that we currently benefit from. So with this in mind, international groups should start to look at their corporate tax structure and see where withholding tax costs may arise post-Brexit. The UK already has a wide treaty network, but of course there will, and for the most part, these treaties reduce withholding taxes to nil. But there are some notable exceptions, including Germany, and so we encourage corporate or large corporates to start thinking about the withholding tax costs at this early stage. My third tip focuses on research and development reliefs. The UK has a generous R&D regime for both SMEs and large corporates, and this is currently funded by the EU. We know that from the autumn statement last year, the Chancellor has committed to maintaining or perhaps enhancing those R&D reliefs going forward. However, in these uncertain times, there are no guarantees. So I think my third tip would be to ensure that UK manufacturers are maximising the R&D reliefs available now to ensure that they are minimising UK corporation tax and improving cash flow where possible. There's a 2-year time limit for submitting R&D claims, so where appropriate, businesses could go back and review historic R&D claims with a view to submitting amended returns. Moving on, I just want to touch on the OECD's base erosion and profit shifting project. This kicked off in 2012, and when the OECD were commissioned to review the harmful tax practices that were being used by multinationals such as Amazon, Google and Starbucks. And this resulted in a 3-year project, which culminated in some recommendations being published by the OECD in October 2015. Following those recommendations, the UK has been proactive in terms of amending current legislation and also introducing new tax rules, including things like diverted profits tax, country-by-country reporting, and interest limitation rules. So the fourth tip is really for larger corporates to start making sure that they have assessed how BEPS will impact their group structure if they haven't done so already, with a view to prioritising key areas where they may need to take some action to reduce additional tax cost and ensure compliance going forward. No day would be complete without name-checking Trump. So US elections have been sort of front-page news for a while. And one of Trump's key aims is to reform the US tax system. This includes reducing the corporate tax rate from circa 35% down to around 15%. And in order to fund these reductions, there are a number of proposals being put forward. one of which includes a border tax adjustment, which broadly means that US companies will be incentivized to source products and materials from within the US. For UK manufacturers that rely heavily on the US market, this could pose some problems, and so therefore companies firstly need to make sure that they are monitoring US tax reform, but also start to think how they could amend or change their current business structure to mitigate the impact of potential border tax adjustments or similar adjustments to the US tax system. So one example might be, to consider using a US company to manage the contracts within the US, with the UK performing a toll manufacturer role to perhaps mitigate the impact of the border tax adjustment. Clearly, this will need further consideration as the US tax reform evolves, and we recommend that this is discussed with advisors at the earliest opportunity so that you can continue to plan as things develop. Moving on, I think given all of the above changes, large corporates should now use this as an opportunity to review their global value chain. An external review of commercial substance alongside tax and transfer pricing policy should help to identify any tax risks that have arisen from changes in international tax law, and will also help surface any efficiencies that could be derived from amending value chain. And finally, I think the seventh tip really is just a more general one, particularly aimed at smaller corporates. And that's to not be put off by the complexities around the changes in the international tax landscape. There's a lot of optimism within the UK manufacturing market, both at home and abroad, and so businesses shouldn't be put off by exploring new opportunities. So we'd encourage you to talk to your advisors about expanding overseas and continue with your ambitions and plans to grow, making sure that you have visibility as to how your tax profile will be affected as you do so.